We have not seen much of an easy and restful summer so far. The headlines were dominated either by news about the spreading of the Delta variant or about the floodings and bushfires that have been abated by the climate change and destroyed many lives and many areas. At the same time, on the economic side, we have seen that the sentiment indicators, as expected, peaked and are moving on a high plateau. The GDP data for the second quarter have been good, although in some regions a bit disappointing, and that inflation continues to go up and surprisingly goes up. In this environment, equity markets have been a bit more volatile, but still heading upwards. But as a surprise for us, and I think a new conundrum, long-term interest rates kept falling substantially and real rates went down to new record lows. This new interest conundrum is likely to be solved at some stage in the future. We tried to decipher this whole thing and came to the conclusion that most of the factors causing this fall in long-term yields were caused by either positioning or supply-side developments. In our view, these are likely to go away in the near term, and we are going to focus again on the fundamentals. And those fundamentals, in our view, still look pretty good. Despite the spreading of the Delta variant, we expect that the economic recovery continues and inflation will at least stay high for some time. In this environment, in which also the labor market is likely to improve, the Fed is likely to go ahead with its plan for tapering. And although the ECB will follow at a later stage, we will see this Fed move as a change in the global environment of monetary policy. And in this environment, long-term yields are likely to go up. As this probably will cause some correction in riskier assets, we advise to increase the cash positions for the time being. Looking forward to the next couple of years, we continue to believe that this economic recovery is likely to be strong for quite some while before we get in a kind of a transition period and then moving in 2025 or so in a likely new normal in which GDP growth is likely to be somewhat lower than in the pre-crisis period and inflation probably somewhat higher. In this environment, long-term yields are likely to increase somewhat further in the next couple of years. There are risks to this medium-term outlook. And the major risk for the next 1 or 2 years by far is the pandemic and the coronavirus. But going ahead, we think the risk universe is changing. And in our view, one risk what is apparent right now already, namely the conflict between the US and China, is becoming more dominant. If this materializes, there will be substantial negative implications for global supply chains and financial markets will be hit.